Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, January 3rd, 2025. If you need further convincing that Wall Street is waiting until Trump takes office before it starts reacting to what he intends to do, just take a quick look at the behavior of stocks and bonds over the past month. Now here's the S&P 500, which this is the past 6 months, and we go back. Let me just hit that again. Peaked above 6,000 1 week after the November 5th general election. And since then, it gained a little ground, lost a little ground, but net has gained no ground. In fact, it's actually slightly lower now than it was here, as you can see on November 6th, the day after the election. Almost the same. Anyway, point is, basically stuck in a trading range for the time being. Now let's look at the 10-year Treasury note. And this is also a 6-month chart. The yield on the 10-year Treasury note has also continued to stay in a narrow trading range, around 4.6% over the past 2 weeks. So if you look at this chart here, over here on the right, that's about 2 weeks ago there where I have it, and you can see it's just almost flatlined here. Now, if we go back year to date, let's go back 1 year, I guess, because year to date would be just 2 days today. But you see back here in late April, mid-April, it got up to about 4.7%, so it's basically bumping up against its near-term technical resistance. Now let's take this out 5 years, and you can just see that this is where it's been peaking throughout this whole kind of post-pandemic recovery. So there's nothing wrong with that, but point being, bond traders aren't really now betting one way or the other. Now that we got that decision out of the Fed a couple weeks ago, this is where they've decided the 10-year Treasury note should be priced at 4.6%. Now let's look at gold. Again, here's gold over the past 6 months. Now you can see back here, also just before the election, the price of gold peaked, but it's been flat since then. And back then it got up to almost $2,800 an ounce. Then you can see here, about a week or so after the election, down below 2,600. Since then, it's come back above, but you can just see now it's bouncing around in this range. And that's because gold really, people think of it as an inflation hedge, which really I don't think it's primarily that. It's more of a proxy on the strength of the US dollar and the perception of how the dollar is going to perform, say, going forward. And right now, that's up in the air because depending on what the Trump administration really tries to implement with, like, for example, trade tariffs, could have little or no effect, or it could have a big impact on the currency market. So that's also another wait and see kind of thing. That's why Wall Street is just kind of sitting on its hands. Now, what has ticked up recently is the price of crude oil. So here's crude oil. Let's go back 6 months, say, and here it was under $67 a barrel. What date is that? December 5th, December 6th. So basically 4 weeks ago. And now it's above $74 a day. So if you look at this uptick here, it's too soon to declare the new trend's been established, partly because when it gets up around $77 a barrel here, it'll start hitting some technical resistance. But if it breaks above that, and now we go a little bit further out, then it could get all the way up into the mid-80s before it starts encountering more resistance. So if it does break above that, say, $77 level or so, then we may be looking at a new normal for oil prices around $80 a barrel heading into summer. Remember, winter is usually when oil prices drop because there's less demand for gasoline. But of course, there's other things that affect supply and so on. So, but nevertheless, to have oil kind of with that pronounced of an uptick in a short period of time does mean, at least in the energy markets, they felt like oil was priced too low. So anyway, that is the one price that's kind of moved out of its trading range since the election. Now, none of that's particularly concerning. Wall Street is proceeding cautiously, as it should do, when there is so much change in the air. It isn't abandoning the stock market, but it's taking a risk-off approach to equities until it feels more confident in its assessment of what changes to expect this year in trade policy, income taxes, and federal spending. As I noted last week, that is always the case when there is a change in political leadership. So I'm not too concerned about how Wall Street is reacting to what I view as a normal sequence of events. In fact, I will feel encouraged if we make it to Inauguration Day on January 20th, without any further backsliding in the stock market, because that would tell me that this is all just wait and see kind of stuff going on, but is not necessarily indicative of a lack of confidence in the economy. Now, and by the time we get to the second half of this month, we'll start seeing, fourth quarter and full results for most companies, along with their guidance for the year. Now, I expect that guidance for the second half of this year to be muted and vague, since so many things could change during the first half of the year. In other words, pardon me, for the same reason that Wall Street's not committing itself right now, I don't think these companies are going to want to try to predict 9 months from now, how profitable they're going to be, especially if they engage in international trade. I mean, a lot of these companies, I think, will basically either provide very, very general guidance with wide parameters, or they'll just say, look, we're going to wait until we release our next set of quarterly results in April, when we've seen, the Trump administration, every presidential administration during the first 100 days has their priority list of legislative items that they want to get approved. So by April, we'll know what those things are. We'll have a pretty good idea of which ones, we're going to pass in their current form or as contemplated, and which ones maybe won't pass at all or are going to require some pretty significant change. So I just think we're not going to get a lot out of these companies in the way of their guidance. However, if those predictions reflect continued growth in per share earnings this year, then I see no reason why the stock market should not break out of its trading range sometime maybe late during the first quarter of this year. So that's this week's update. I hope everyone had a wonderful new year. Look forward to talking to you in another week.